how to invest in Asia in 2021 and beyond. Again, just another all-important disclaimer for you. And then the contents, how we got to where we are, which is the bit I'm really good at, because that's telling us what's happened, key themes for 21 and beyond, then a few conclusions before you can get rid of the monkey and then let the two organ grinders take over. So how we got to where we are right now, Asia and Japan. And this is just looking at some statistics really over the past year. It's almost a year to the day since financial markets fell out of bed, began to take the coronavirus outbreak very much more seriously. It had moved from China, begun to spread out of Italy, and begun to reach Western Europe and America. And that was when risk assets began to think that this was perhaps a more serious problem than they had previously anticipated. But since that time, the 21st of February, look what the best performing markets have been in total return sterling terms. On the left-hand side, as if by magic, Japan and Asia Pacific. Everybody bangs on about how wonderful America's been. Now, obviously, some of America's recent loss of performance is down to weakness of the dollar, but America's basically grabbed most of the headlines for the last year because of tech and those FANG and social media and internet companies. But actually, Asia's pretty well blessed with those as well. And overall, those markets have performed very, very strongly. It may be because they were first in, first out. It may be because they've been here before, with SARS, for example, 15 or 17 years ago. It may be that they just dealt with the situation much more quickly. But whatever you think may be the case, Japan and Asia have been standout performers during what's been a very, very difficult time for equities. And since Pfizer Monday, not quite so good. Still in firmly positive territory. Intriguingly, the UK has sneaked up the ranks, having been a tail end Charlie amongst domestic markets. And actually, it's been sufficiently risk on, as you can see, for Asia, for Africa and the Middle East, I should say, for actually to be the best performing market in total returns in sterling terms since Pfizer Monday. And you can see to the degree that America has lagged since then. Again, a lot of that is down to dollar weakness, but equally a lot of that is down to investors perhaps looking for turnaround plays, cyclical plays, recovery plays, value, for want of a better turn of phrase, and it's not the most helpful phrase in many ways. And certainly with America being packed with those secular growth tech stocks, that's perhaps not been quite so much in favour since Pfizer Monday. There's been hopes and expectations of a recovery. Now within Asia, again, you've got a huge spread of market performance. The big export-driven markets have been particularly powerful, Korea and Taiwan, and I'm sure we may hear a little bit about silicon chip industry and semiconductor shortages shortly from Ian. So they've been phenomenally strong. Where you haven't got such the degree of recovery, perhaps the more tourism exposed players like Thailand, which gets about 13% of its economy from tourism, for example. And then the Chinese market's generally done very well, and Japan, it's excellent performance, hard to ignore. It's the Topics Index trading at its highest level now, I think, since 1990. But the laggards have generally been, over the last year, those have been most hit by the loss of tourism. The leaders have been the export players. And since Pfizer Monday, similar sort of trends. Actually, the tourism players are starting to catch up a little bit, but it's still Korea at it, hammer and tongs at the top of the leadership chart there. So that's the history lesson, as it were, in terms of how we've got to where we are. Some very, very clear themes there, which you've seen played across developed markets as well. This shift from growth to value, want of a better turn of phrase, hopes, expectations for a strong cyclical recovery going forwards, buoyed by proactive monetary policy, proactive fiscal policy. So very similar themes to what we're seeing in the developed West as well. But emerging markets have come out of the last year incredibly well in Asia, and Japan has been a fantastic performer, casting off, this reputation for being a serial underperformer, which probably wasn't fair anyway. So here we go. So here are the possible reasons. Asia, first in, first out, better prepared after SARS in 2002-03, and financially better prepared after the lessons of 1997-98 and the Asian currency crisis, when Thailand, the Philippines, Indonesia, Korea got involved in a debt crisis. Their currencies were devalued, the IMF was brought in, and those lessons have been learned and taken on board. So public debt to GDP, much lower generally than it is in the West. These have had the financial flexibility to spend and not be too worried about it. Whereas, in the UK, was already high, the US debt was already high, it's gone through the roof to record levels as a percentage of GDP, isn't stopping the Americans trying to spend, won't stop Chancellor Sunak next week looking to provide further support to the economy. But the questions are now bubbling around. At what point do governments look to try and at least make a pretense of balancing the books, and what will the impact be? That hasn't been such a debate that I'm aware of, at least from my 30,000 feet view. in Asia because their finances are just much more healthy, both the government and indeed to a large degree at the corporate level. Also, there's this, again, America gets an awful lot of headlines for Facebook, Apple, Alphabet, Netflix, and so on. But Asia and Japan are very well adapted in some cases to Internet 2.0, the industrial internet. And also because you've got the valuations are less stretched, there's perhaps potentially more value to be had, as we'll explore in a moment. So in terms of those key themes, this looks at valuation. Now, there are lots of different ways of slicing it, but this is just looking at current forward PE relative to the average since 1990. It's not a perfect science by any means, it's an art, and it does rely upon analysts' forecasts, and we all know that analysts generally tend to be wrong, and that's not to poke holes in them. I've been one myself at UBS Investment Bank for 12 years covering tech stocks, so I know how hard it is to make earnings forecasts, and I know it's hard because I don't have a crystal ball just like everybody else. Analysts, generally speaking, underestimate operating leverage on the way down, underestimate operating leverage on the way up. So they underestimate the degree to which earnings fall during a downdraft, underestimate the degree to which earnings rise in an upturn. So let us see. But at the moment, at least on current forward PEs, emerging markets in Japan don't look too bad relative to the developed West, and equally relative to their history, emerging markets on these numbers look pretty okay. All right, not screamingly cheap, but by no means expensive, unlike you could argue America is. And Japan, okay, well, I know we can perhaps argue that some of the valuations back to 1990 were pretty potty, but equally relative to its recent 30-year history, Japan isn't bad value at all. And I think you can probably dig up similar statistics looking at less variable numbers like price to book value that may show you similar things. So certainly this, if you are looking for that ideal combination of downside protection and upside potential, because you've got some cheap valuations here, on these numbers at least, if they're reliable, Japan and emerging markets offer you a little bit more to chew on than, say, the United States. Now, other key themes, okay, China, Asia and Japan have continued to outperform, though not quite as clearly. China has lagged a little bit. Possible reasons why perhaps the outperformance hasn't been so dramatic. Well, they were less badly hit, so you could argue there's potentially less recovery potential in some cases, but that's not the same again with the tourism plays, for example, like Thailand. Export plays very much to the fore, Korea and Taiwan. The tourism lag is catching up. And again, this value versus growth debate, as in terms of looking for cyclical recovery plays, leverage into the global economic upturn, Asia and Japan are both good places to go. Now, China lagged a little bit. There are lots of different reasons why that might be. Concern over the intervention in the Ant Financial IPO, perhaps. Concerns over Chinese growing political influence and economic influence in Hong Kong, and whether the one country, two systems mantra there is coming to an end. Worries over Chinese debt and where it is. It's probably somewhere in the middle between state and companies with state-owned enterprises. And then governance issues with the Luckin Coffee scandal, and American saber rattling on trade hasn't gone away. So there are possible reasons why China is just perhaps lagging the Asian pack a little bit. And also the People's Bank of China has been tweaking overnight borrowing costs. It does seem concerned about the possibility of equities getting bubbly again after 2007, after 2015. The US Federal Reserve seems quite happy just to let things bubble away, so far as we can tell. The People's Bank of China seems a little bit more on the ball, dare one say. And there is a possibility perhaps that China's already thinking of withdrawing stimulus, also not being as aggressive as the Americans who continue to ladle it on with the trowel, with President Biden talking about another $1.9 trillion in January, and then maybe even another billion on green infrastructure projects by the end of the year. But also equally a key point here for Chinese watchers, 14th five-year plan will be out in March. So that'll give us a better feel for what they've got in mind. And also the Chinese Communist Party celebrates its 100th anniversary in July. So although it won't want bubbles and things to get too overheated, the chances of it wanting to have another year of disappointing economic growth, I would suspect, are on balance pretty small. So this then just looks at the sort of things that people like me like to play with around all the time. This is the 30,000 feet look, and I know lots of emerging market and Asian equity, what the fund managers push back on this is a bit crude, so I defer to Ian very much. But it doesn't require any fiddling with the scales to make this one work. It probably works better for emerging markets more generally, because then you get Latin America and Eastern Europe brought in. But nevertheless, there is a sense that you can argue the case that when commodity prices are doing well, Asia does well. Now, you can't be clearly blanket about that because lots of Asian countries are net importers of commodities. to be foolish of me to say that soaring oil prices are good news for oil importers, because that probably isn't true, but I guess it's perhaps indicative more generally of how commodity prices doing well. There's a proxy there for perhaps global economic growth doing well, and Asia seen as an export player and a global player. Therefore, the two perhaps do go together, even if not perfectly. And also the same in terms of a more risk-on financial market sentiment, which can be reflected through the US dollar and the trade-weighted DXY index. Again, this isn't perfect by any stretch of the imagination. Again, it's the sort of thing that strategists love and bottom-up fund managers probably detest. But again, you can make the case that a strong dollar is generally unhelpful for emerging markets in Asia, and a weak dollar is generally helpful and gives them a bit of a boost, partly because although Asian markets took on the lessons of the harsh lessons of 97, 98 very well, there is still a lot of debt there. There is still debt there in the system. A lot of it's dollar priced. So if the dollar goes up, then that makes servicing that interest much more expensive in local currency terms, and money is siphoned away in interest payments that could otherwise be used perhaps more productively in terms of investment. So those are things that at the moment, at least, have been running Asia's and emerging markets ways more generally. Commodity prices, dollar, so certainly hopes for an economic upturn, and therefore wider risk on appetite. So those are two little rules of thumb to keep an eye on from an eagle's eye view. And Japan, this just again suggests that, economy strong, doesn't do any harm at all for Japanese equities. This is the Tankan. This is you can argue a lagging indicator because it comes out every quarter, and the Nikkei you would expect really to be more wise to the game and be anticipating improvement. But again, certainly an improvement in Tankan doesn't do any, which is I guess the equivalent of a purchasing managers index that we're used to over here in the West, doesn't do any harm for Japanese equities. And again, Japan, this is just looking at growth versus value through the prism of the wider topics index in Japan. Growth has, as we've seen in America and the West, murdered value, had it absolutely stone cold since the end of the global financial crisis. If the chart is going up, then growth is outperforming value. If the line is going down, then value is outperforming growth. And we just start to see perhaps the first signs that markets are looking for, again, crude term value, growth now, as it were, cyclical growth from low bases, economic turnaround plays, rather than secular long-term growth that has dominated so much in the mush that we've had economically over the last decade of low inflation, record low interest rates, quantitative easing, fiddled about with yield curves and flattened yield curves and everything else. So history would suggest, and history is by no means a perfect guide, if we do get an inflation recovery and bond yields tick up a little bit and central banks even have to just talk about rising interest rates, you might see move towards growth now and cyclicals and away from growth in the future and tech to a degree, for example, because there's going to be lots of it if things go well from a low base, and it's also going to be a heck of a lot cheaper potentially as well after that massive underperformance over the last decade. And just in terms of growth versus value, if you are looking at China, and we've had a few questions on it, if you are looking to do that through an index tracker or a fund rather than an individual stock, and your fund managers will be there to help you with that, if whichever index you look at will have a bit of an influence on what you get into. So you do need to do your homework on which index you're looking at and which market you're looking at, because as you can see here, the compositions of the leading Chinese indices are very, very different. Just as, say, in the US, looking at the NASDAQ, I guess to which is probably more closely related to the Chi Next on the right hand side, relative to the broader indices here on the left, the Shanghai Composite and the Shenzhen Composite, with Shenzhen probably looking at more domestic players. And again, you can see very, very clear differences in weightings in technology being a particular example, also financials being a key swing factor there, and industrials being another big constituent of those indices, or certainly a huge variance. If you're looking at a tracker, you're looking at a fund, you need to be aware of perhaps what the benchmark of the actively managed fund is, or of that passive vehicle, if that's the way that you prefer to go. So again, and that all will again tie into this cyclical recovery, growth versus value, vaccination program, stimulus, and all those different things that have been keeping markets jogging along quite happily and keeping them occupied for the past year or so, since the pandemic was first starting to run riot. So in terms of conclusions, I mean, it's a phrase I hear a lot. I've tried not to use it, but it slipped in at the end. The Asian century, strong demographics, the rise of the middle class, well positioned for the industrial internet, superior infrastructure, great healthcare systems, better finances. So there are lots and lots of long-term reasons for looking at Asia, for example. But it hasn't stopped them, those markets finding life pretty tough over a lot of the last decade until their renaissance recently, because they are still prey to short-term hot money flows, political uncertainty, corporate governance issues, and this trade issue of Beijing versus America refuses to go away. But nevertheless, no lesser authority than Charlie Munger, Warren Buffett's business sidekick, the strongest companies in the world are not in America. I think Chinese companies are stronger than ours, and they're growing faster. So that's something for everybody to think about, including a lot of their Japanese competitors. So that is a whirlwind tour in 19 minutes. I make it. So thank you very much for your time, everybody.